Hello, everyone, and welcome back to the Deep Dive. I hope you're ready to put your analytical skills to the test, because today we are tackling the undisputed king of global finance, Blackstone Inc., ticker symbol BX.
It's a giant, an absolute giant.
We're breaking down a financial institution that manages, over $1.2 trillion in capital now. It's right at the center of this huge secular shift toward alternative assets.
Yeah, it really is.
But here's the central question we really have to answer. Blackstone, it looks like a financial fortress, a machine just built for permanent compounding.
It does.
Is its current pretty lofty valuation, is that truly justified by its sheer scale and all the structural advantages it has? Or, and this is the key, or are there complex, maybe often ignored structural risks, particularly those driven by today's high interest rate environment? Could that create a potential trap for long-term investors?
Right.
We need to find out if this is just a wonderful business or if it's actually still a wonderful investment opportunity today.
That is precisely the needle we have to thread. And, understanding Blackstone isn't about just reading a quarterly report.
No.
It really requires dissecting a multi-decade compounding structure, analyzing its unique competitive mechanisms.
It's a whole system.
It is. And before we get into the details, just a quick note for everyone watching about the practical side of investing.
Yeah, good point. For those of you who want to act on the investment frameworks and the ideas we discuss, having a professional-grade platform is absolutely critical for execution.
You need the right tools.
Exactly. We've partnered with Interactive Brokers because they offer the kind of global reach and, the sophisticated tools required to analyze and invest in companies on Blackstone's scale. So if you use the link below, you get access to their platform, and we're also able to provide a viewer stock bonus, which kind of helps you get started.
So you get the advanced tools, you get a bonus, and you support the deep analytical work that goes into preparing these sessions. That link is right there for you in the description.
That's right. And of course, if you find value in this kind of in-depth, long-form discussion, the kind that helps you gain real conviction and get informed quickly, the best way to let us know and to make sure you don't miss the next deep dive is to subscribe, like the content, and please manifest your questions or insights in the comment section below.
Your engagement really does drive what we analyze next.
It really does.
Perfect. So, with that out of the way, we'll get back to the analysis. We're starting with the fundamental pillar, understanding the interlocking competitive advantages that form the core of Blackstone's quality.
Okay, let's unpack this business model, because you're right. It's surprisingly simple at its core, despite the, the $1.2 trillion in assets under management.
AUM, yeah.
They manage capital for the most sophisticated players in the world. We're talking pensions, endowments, sovereign wealth funds.
And now, increasingly, high net worth individuals. That's a huge new channel.
It is. And when we break down how they make money, it's this two-tiered system. But those two tiers are valued so wildly differently by the market.
That's the key.
The first tier, the one the public markets give that high multiple to, is fee-related earnings, or FRE.
FRE. And that stability, that predictability, that's what gives Blackstone its premium valuation floor. These are recurring fixed management fees.
Like rent, basically.
It's exactly like rent. It's charged as a percentage on the total AUM base. This fee is typically, low single digits, maybe 1% to 2% for private equity.
Get lower for some of the bigger credit funds, I imagine.
Potentially, yeah. But what's so crucial is that this fee is paid regardless of whether an asset gets sold or what market conditions look like that quarter.
Right.
It's just recurring rent on capital they manage across all four major segments: private equity, real estate, credit and insurance, and their hedge fund solution.
So that income stream provides this just incredibly resilient, high-quality floor for the firm's profitability.
An extraordinarily resilient floor.
Yeah.
Yes.
That predictability is everything. That's what lets them pay their people, cover overhead, fund expansion, even when asset sales just, grind to a halt. But then you layer on the second stream, which is the high-octane, high-margin, but fundamentally volatile component.
The performance fees. Or incentive fees.
Carried interest, yeah.
And this is where the lumpy, explosive growth potential comes from. These fees are earned only if and when their funds beat a predetermined hurdle rate of return.
So they have to perform first.
They have to perform first. Think of a typical private equity structure. The clients, the limited partners or LPs, they have to get their initial capital back plus a preferred return.
Which is often, what, 7-8% a year?
Usually in that range, yeah. Only after that does Blackstone get to take its carry, which is typically 20% of the profits above that hurdle.
So it directly ties their big payday to the asset's performance.
Performance, and just as importantly, the ultimate timing of the sale, the realization. And that timing is totally discretionary and it's so sensitive to macro conditions, which is why net income can look so volatile.
So at its simplest, the business model is really built for endurance. They're this trusted intermediary collecting management fees, the rent and performance fees, the profit share.
That's it.
And that role, just being the allocator of choice, it seems structurally secure for decades to come.
It is, because this isn't just a fad. We are living through a multi-decade, I would argue, irreversible structural shift in global finance.
Okay, explain that.
The institutional investors, we're talking about the massive pension funds, university endowments, sovereign wealth funds, they're all facing the same problem.
Their liabilities.
Exactly. They have these huge liabilities, pensions to pay, grants to fund, that traditional public equity and bond markets often can't consistently cover with the returns they need.
They need a higher return.
They need higher, less correlated returns, and they find them in alternative assets. The illiquidity premium of private equity, the steady yield of private credit, the stability of infrastructure.
And Blackstone isn't chasing this trend.
No, it is the trend. It sits right at the epicenter, positioned to benefit as those institutional allocations move from, say, 10% of their portfolio to 15, maybe even 20% over the next decade.
And this feeds right into the human element of it all, this flight to quality and scale.
Yes.
If you are managing a $100 billion pension fund, the cost of making a mistake on your alternative manager it's just catastrophic. You can't meet your legal liabilities.
That's the psychological moat right there. When you need to deploy $500 million or $1 billion into a specific asset class, let's say European logistics,
Right.
you prioritize certainty and risk management above everything else. You don't take a gamble on some emerging manager, even if their recent performance looks amazing.
You go with the sure thing.
You go with Blackstone because they offer consistency, global deployment, deep operational expertise, and a track record of rigorous risk control. They are the benchmark. And that behavior, driven by institutional caution, just reinforces Blackstone's dominance.
So let's define the moat more specifically. It's a mix of brand and reputation, that intangible asset, and then the hard power of sheer scale, the $1.2 trillion in AUM.
Mm-hmm.
How does that massive scale translate into real, tangible advantages for them?
Well, the scale is the foundation of their superior execution. Look at deal flow. If you are selling a multi-billion-dollar asset like a portfolio of data centers or a huge logistics platform.
The seller cares about a few key things.
Right. Price, certainty of closing the deal, and speed. Blackstone, with its massive dry powder that's uninvested client capital and its reputation for actually closing complex deals, they often get preferred access.
They get the first call.
They get the first call. This means they can frequently bypass competitive auction processes entirely and source proprietary deals.
And why that's so important?
Because proprietary deals are often bought at a lower entry multiple than assets sold in a big auction, that directly boosts the potential for higher returns. Scale lets them see assets that rivals never even get a chance to bid on.
And then that successful track record loops back and gives them measurable pricing power over their own clients, the LPs.
Precisely. Because Blackstone funds are consistently oversubscribed, meaning they could raise way more capital than they actually ask for. They don't have to beg for money.
They dictate the terms.
They dictate the terms. They can command premium management fees compared to most of their peers, often without giving ground on the carried interest structure. And crucially, their popularity lets them structure funds that lock up capital for longer, 15 years, sometimes more.
It just enhances the stickiness of that AUM base even further.
It does.
And this gets us to the self-reinforcing aspect of the moat. It's not static, it's a dynamic, widening chasm. This is where you really see Munger's idea of a system of interlocking competitive advantages.
It's a powerful positive feedback loop, a classic winner-take-all dynamic. The logic is just, it's self-evident.
Lay it out.
Massive scale generates an enormous amount of proprietary data and real-time operational expertise across all these different geographies and asset classes.
Okay.
That data and expertise leads directly to superior investment performance. Superior performance solidifies the brand and reputation.
Which then makes fundraising easier.
Way easier. That stronger brand guarantees easier, faster, and larger fundraising campaigns, which results in even greater scale. Every successful fund launch makes the next one almost exponentially easier. It creates an almost insurmountable barrier.
And the most strategic move in recent memory to sort of institutionalize this advantage has to be the pivot to perpetual capital, which has been some time here.
We have to. This is the game changer.
This is why the market gives them that premium on the FRE stream.
Absolutely. Traditional private equity is all about finite funds, 10 to 12 years typically. At the end of that, the assets are sold, capital is returned to the LPs. That creates fundraising risk.
You have to go out and raise the next fund.
Right. Perpetual capital vehicles, especially the ones aimed at the private wealth channel like Bright for real estate and BXPE for private equity, they just fundamentally change the math.
How so?
The capital in these vehicles is, for all intents and purposes, locked in. Or at least it's far less sensitive to market cycles than traditional funds.
So the fee-related earnings from those funds.
It transforms from a temporary stream into what is effectively a long-term annuity. Instead of having to re-raise capital every decade, that capital base is structurally enduring.
Which means their core stable revenue floor, the FRE.
It's becoming increasingly immune to market shocks, and that level of resilience absolutely warrants a higher valuation multiple from the public market, no question.
That makes perfect sense. They're trading that volatility of fund expiration for just structural fee certainty. But let's check their flanks. I mean, Blackstone is the leader, but rivals like Apollo and KKR are titans, and they have their own unique advantages.
They do. Apollo, for instance, has executed this brilliant vertical integration strategy focused heavily on credit and insurance.
With Athene?
With Athene, exactly. By leveraging their ownership of Athene, this massive insurance carrier, Apollo has secured access to a liability-driven permanent capital base in the hundreds of billions.
And that capital is stickier than even institutional pension money.
It is, because it's tied to long-term insurance liabilities. That gives Apollo a key structural advantage, a guaranteed, self-funded, highly stable pool of permanent capital for their credit strategies.
And KKR, they've focused more on the generalist private markets, but they're often cited for a cultural advantage.
Yeah, specifically the early adoption of broad employee ownership. KKR recognized really early that the ultimate value creation happens at the portfolio company level.
Not just at the partner level.
Exactly. By spreading equity ownership broadly across the management and employees of the companies they buy, they create this powerful alignment that goes way beyond just the senior partners.
And that deep alignment could potentially drive superior operational value creation over time.
It's an intangible cultural edge that can definitely show up in better returns.
So when we stack these up, Apollo's insurance capital, KKR's cultural depth against Blackstone, where does Blackstone's durable edge really lie?
I think Blackstone's primary durable advantage remains its unparalleled global multi-asset class diversification, combined with its sheer scale and the premium its brand commands.
They're not just a leader in one or two areas.
No, they are consistently dominant across private equity, real estate, credit, and hedge fund solutions, and they do it globally. For the biggest institutional investors who are looking for a one-stop shop for alternative exposure,
Blackstone is often the only real choice.
it is. They command the central toll booth on the highway of capital, shifting into alternatives.
Okay, so that interlocking moat provides the structural defense. But the sustained performance, that relies entirely on management quality, the stewardship of that capital. And here, you have to talk about the owner-operator mindset, right?
You do. It's exemplified by Chairman and CEO Stephen Schwartzman. It's non-negotiable.
His tenure goes back to the firm's founding in, 85? We're talking about a management philosophy that is just inherently long-term.
And it's driven by that belief that you have to tackle big, transformative problems with scaled solutions. You can see it in his own writings.
So how does that owner mindset translate into day-to-day operations?
It translates into operational rigor, specifically through pattern recognition and thematic investing. They aren't trying to time the market. They're trying to identify these non-cyclical secular trends that will play out over decades.
Like what? What are some examples?
Well, the massive capital needs for logistics and modern warehousing driven by e-commerce, the essential infrastructure for life sciences lab space, specialized facilities, and the foundational shift of corporate financing away from banks toward private credit.
So they focus their capital into these high-conviction areas.
Exactly. It minimizes operational drift and ensures that large-scale capital gets deployed efficiently.
And that philosophy is deeply reflected in their incentive structure. I mean, we know there's significant insider ownership.
And the compensation is heavily weighted toward long-term value creation. It's tied to fee-related earnings and distributable earnings.
Which is critical for public shareholders.
It's so critical. Management isn't paid just for increasing AUM this quarter. A huge portion of their wealth is directly tied to performance fees from funds that might not even liquidate for another 10 years.
So they're forced to think long-term.
It ensures they are constantly focused on that distant horizon optimizing long-term performance and the structural growth of FRE, which is perfectly aligned with maximizing public shareholder returns over the long haul.
Okay, let's move to rational capital allocation, another hallmark of a wonderful investment. They have a pretty exemplary track record here.
They do. Their capital is constantly deployed to fuel that growth engine, reinvesting into new fund launches, expanding into new geographic verticals like Asia-Pacific credit.
And probably most importantly,
recruiting and retaining the absolute top-tier talent in every niche they operate in. They get that a high-performing private equity firm is a people business, first and foremost.
And their approach to shareholder returns seems equally rational. They use a flexible variable dividend tied to distributable earnings, DE, and then opportunistic share repurchases.
That variable dividend is a sign of real financial maturity. It pays out when the cash profits are actually realized, when assets are sold at a profit, and it scales back when realizations are slow.
So it preserves financial flexibility.
Maximum financial flexibility. They aren't forced to take on debt or sell assets at the wrong time just to maintain some unsustainable dividend policy.
And the buybacks.
Their opportunistic share repurchases, especially during periods of market stress or depressed DE, that's a strong signal that management understands when the stock is trading below its intrinsic value. They act like rational owners.
But again, the single most rational capital allocation decision they made wasn't a buyback.
No.
It was that structural shift towards perpetual capital funds.
Absolutely. That decision, which took enormous time, resources, and brand reputation to pull off, it signaled a clear prioritization of structural quality over short-term fee volume.
They were playing the long game.
They willingly traded the temporary volatility of traditional fund structures for an enduring, stable AUM base that inherently commands a higher valuation multiple from the market. It shows a management team playing chess, not checkers.
Now let's talk hard numbers and why this really is a financial stronghold. We said profitability is high, but cyclical. The consistency is from FRE, but the big swings come from the timing of those realizations.
Right, and you have to look beyond GAAP net income. It's famously complex and often just not relevant for these kinds of firms. We have to rely on key quality ratios. Let's start with return on equity. ROE.
Okay.
A rolling last 12 months ROE for Blackstone often sits around 25 to 30%.
That is a staggering number, especially for an asset manager of this size. It signals phenomenal capital efficiency.
It does. It means they generate a quarter plus of profit for every single dollar of shareholder equity they deploy. It's a mechanical reflection of their business model.
They manage huge amounts of capital without needing a huge balance sheet.
Exactly.
Right.
Without taking on corresponding amounts of risk or huge amounts of debt on their own balance sheet. It is a true compounding machine at work.
Okay, let's dedicate some serious analytical time to distributable earnings, to DE. Because this is where the analytical rubber meets the road for investors in these companies.
It really is.
Why is GAAP net income so often misleading here? And why does DE matter so much?
Okay, so GAAP net income is often useless because it includes large amounts of non-cash compensation stock and unit awards tied to fund performance, and it also includes unrealized gains or losses.
Paper gains.
Paper gains. If the market value of a portfolio asset rises, GAAP sees a gain, but that cash hasn't landed in the firm's bank account. It's not real yet.
So distributable earnings cleans all that up.
It's the clean, cash-based profit metric that truly matters to shareholders. It effectively measures the cash generated from management fees, the FRE, plus the cash realized from actual profitable asset sales, the carried interest.
Minus expenses.
Minus operating expenses, and importantly, subtracting the cash portion of compensation paid to employees. It is the money available for dividends and buybacks.
And that number is substantial.
At $7 billion LTM, that figure confirms the firm's robust capacity to translate asset performance into cold, hard cash profit. It gives you the analytical clarity you need.
And that robust cash flow generation ties right into their balance sheet strength, the fortress analogy. What does their leverage profile look like?
Their approach to leverage is exceptionally prudent. It's designed for survival and for capturing opportunities, not for juicing quarterly returns.
Right.
If you look at net debt to EBITDA, the ratio hovers around 1.25 times. For a global financial giant, that is incredibly low.
So their balance sheet is fortified.
Immensely. They have the capacity to withstand credit shocks, and critically, they have the dry powder and the balance sheet to act as a buyer of last resort during a severe downturn.
They can scoop up distressed assets when competitors are just trying to stay alive.
That's the playbook.
Okay, finally for this section, let's bring in the scuttlebutt. What do the customers and employees actually think?
Well, institutional customer loyalty is incredibly sticky. The LPs, they are mandated to find high returns, and Blackstone has delivered consistently for decades across real estate, PE, credit.
And that success generates powerful institutional trust.
It does. Now, the fees are high. That's the primary complaint you'll hear. But the performance net of fees generally justifies the cost, which is why capital continues to flood their way. When their biggest clients need to deploy $5 billion, they start with Blackstone.
And on the employee side, we see a focus on a ruthlessly high-performance culture.
It is, but it's one that is increasingly focused on alignment, especially with these recent initiatives around portfolio company equity. They get that the talent war is constant, their culture is demanding, but it's high quality and competitive. And this new push to offer broad-based equity ownership to employees within their portfolio companies.
What does that signal to you?
It's a sign of a mature long-term focus on value maximization. By aligning the incentives of the janitor, the engineer, and the CEO of the underlying assets, you ensure maximum value creation for the fund. And that ultimately benefits the LPs and, of course, Blackstone shareholders.
Okay, so with the business quality firmly established, let's shift to the growth trajectory. The future growth engine for Blackstone, you mentioned it earlier, it isn't the saturated institutional market. It's this structural shift of global capital to alternatives, led by the private wealth channel.
That's it. This is the multi-trillion-dollar runway. This is the real scaling opportunity. We're talking about tapping into an estimated $80 trillion in global private wealth.
A pool that historically was just stuck in public markets and traditional wealth products.
Exactly. And now Blackstone is using these flagship perpetual vehicles, Bright and BXPE, as the gateway to this massive retail market.
But this requires a very specific skill set.
It's a multi-decade growth path that demands a specific combination of brand, compliance rigor, and scale. Most smaller asset managers could never do this.
Why not?
Because the individual investor market requires massive trust and brand awareness. Blackstone, with its household name recognition, at least in finance circles, and its reputation for stability, is uniquely positioned to gather that capital.
From high net worth and even mass affluent investors.
Globally, yes. The successful rapid expansion of this channel, especially beyond the U.S. into Europe and Asia, that is the key catalyst for the firm's continued high growth rate.
So we have a wonderful company with an enormous growth runway. Why isn't this just an automatic buy? It always comes down to the valuation profile.
And the margin of safety.
A margin of safety.
Blackstone has always commanded a premium valuation, and the market grants this high multiple because of everything we've discussed, the quality of the FRE stream.
Which they value like an annuity.
Right. The guarantee of AUM growth and the financial flexibility of that balance sheet.
The hurdle is the price. A wonderful company only becomes a wonderful investment if you buy it at a rational price.
That's the key.
If an investor buys today at, 50 times forward FRE, they are essentially pricing in a decade of flawless, high-speed AUM growth.
And that leaves zero margin of safety, no buffer for economic friction, regulatory setbacks, or any kind of performance disappointment.
So for a premium stock like this, the margin of safety is rarely going to be found in traditional discounted multiples.
No, you have to wait. You wait for external shocks or company-specific temporary setbacks.
So we're looking for two specific events. First, a major systemic shock, a market-wide panic, a liquidity crunch.
Something like the initial phase of the 2020 downturn.
Right. Systemic fear causes indiscriminate selling. And it often forces high-quality names to trade at temporary discounts, even though their long-term AUM gathering power is totally intact.
And the second, and maybe more frequent opportunity, is waiting for a temporary depression in the volatile distributable earnings, the DE.
Okay.
This happens when macro factors like sustained high interest rates restrict profitable asset sales, the realizations. The long-term investor should look to buy shares precisely when that volatile DE metric is depressed.
Knowing that the underlying engine, the stable FRE growth, is still humming along.
And knowing that the realization drought is just temporary.
Okay, let's pivot to the key risks, the structural factors that could lead to a permanent impairment of their earnings power.
Risk number one, and it's a big one, is regulatory intervention, specifically the recurring legislative threat around the tax treatment of carried interest.
This comes up all the time.
All the time. Currently, performance fees are often taxed at preferential capital gains rates, not ordinary income rates. If Congress fundamentally alters that structure, say making all carry taxable as ordinary income,
that would structurally reduce the after-tax profitability of the entire business model.
Permanently. It would permanently impair their earnings power. That is a threat that must be monitored constantly. And similarly, if regulators put severe restrictions on the structure or the liquidity of those perpetual funds like Bright,
that could shatter confidence in the private wealth strategy overnight.
It could.
Okay, risk number two is performance degradation. The whole moat is built on them beating their peers and benchmarks.
Right. If Blackstone enters a multi-year period where its flagship funds consistently lag behind, or worse, lose money relative to comparable public indices, the core brand and reputation asset just starts to erode.
Fundraising slows down.
LPs might shift allocations to rivals, and eventually this leads to an irreversible decline in the pace of AUM growth. Even a small, persistent underperformance can have a massive compounding negative effect over time.
And closely related to that is the reputational damage risk, but in that newer private wealth segment.
This is a key vulnerability that grows with scale. If there were a single high-profile failure within one of those retail-focused perpetual vehicles,
or liquidity event,
or, more critically, a major liquidity event where the fund had to substantially halt redemptions, investor confidence in the entire private wealth strategy could just collapse.
Because retail investors prioritize liquidity and trust above everything else.
And breaking that trust, even once, could shut off their most important growth channel for years.
Okay, let's dedicate some time to the biggest macro headwind facing the firm today, which links back to our central question, the protracted high-rate environment. How exactly do high capital costs challenge Blackstone?
The challenge is mechanical, and it's multi-layered. First, high rates restrict profitable asset sales. If debt financing is expensive, potential buyers can't afford to pay high valuations.
Or the firm itself can't refinance portfolio assets profitably to sell them.
Exactly. This creates a realization drought where the firm is sitting on a backlog of valuable assets but just can't monetize them at that high margin performance fee level.
What's the second layer?
Second, assets that are held in funds that do need to be refinanced are now being refinanced at significantly higher debt costs. And this isn't just a temporary inconvenience.
Oh.
It drags down the internal rate of return, the IRR of those assets for the rest of their holding period, and that could lead to lower overall performance fees when they are finally realized years from now.
So this brings us to the second level thinking inquiry. The market consensus sees Blackstone as a blue-chip premium growth stock, valuing that stable FRE highly. But what's the contrarian view that this high rate pressure creates?
The contrarian view is that the market may be underappreciating the lagged risk associated with recapitalizing those older assets at today's much higher debt levels.
Okay.
While the current drought in performance fees is visible, and that should depress the DE metric, the long-term drag on future performance fees from those higher capital costs is harder to model.
And it might be undervalued by the market.
It might be. And if that's true, it creates the perfect setup. A high-quality business trading lower because of temporarily depressed cash earnings, the DE, but with a recovery catalyst already baked in.
And speaking of catalysts, the key unlocking mechanism for a massive surge in earnings is pretty simple and obvious.
It is a sustained decrease in global interest rates.
Right.
A pivot toward lower rates would instantly unlock that immense backlog of profitable asset sales. Capital costs for buyers would drop, refinancing gets easier and cheaper.
And all that pent-up gain from assets they've held over the last 2 years would just flood the distributable earnings line.
You'd see an explosive spike in performance fees and potentially an expansion of the valuation multiple as the market anticipates the realization cycles returning to normal.
So to bring it all together.
To synthesize our findings, the investment thesis for Blackstone is structurally powerful. You have the fortress moat, the disciplined owner-operator leadership, and this immense $80 trillion private wealth runway.
So the bull case is that you own Blackstone as a permanent compounder. It benefits from the unavoidable structural shift of global finance into alternatives. The stability of FRE provides that earnings floor.
And the scale guarantees superior deal flow and performance over the long run.
Okay.
Conversely, the bear case is a formidable counterthesis. The current high valuation leaves no room for error or cyclical disappointment.
Right.
And the material threats, the risk of regulatory change on carried interest, and the tangible drag of a protracted high-rate environment throttling performance fees, those could prevent the stock from performing adequately for years.
Even if the business itself remains excellent.
Exactly.
All right, now for the red team challenge.
Yeah.
Our essential exercise in inverting the bull case. Let's pose the most compelling argument for why an investment in Blackstone could fail to deliver from here.
Okay. It would center on the notion that their massive scale could eventually become a liability of dinosaur status. Blackstone's premium price relies on the assumption that being the biggest means you will capture the highest returns.
The failure scenario would be if the fundamental nature of alternative investing changes and scale is no longer the primary differentiator.
Right. This could happen if, for example, the private wealth strategy just falters due to unforeseen operational complexity in scaling it globally.
Or if superior, highly specialized, niche managers start to consistently deliver better returns net of fees.
Think about specialized areas like synthetic credit, climate infrastructure, or targeted biotech incubation. Smaller, nimbler firms often have an advantage in these niche, complex areas.
And if those niche players consistently outperform Blackstone's massive funds,
LPs will start to shift their allocations away from the generalized giant and toward that specialized expertise. If AUM growth plateaus because Blackstone's size makes it too slow to capture the highest return opportunities,
the premium valuation collapses.
and you're left with a solid but slow-growing business that you bought at a terrible price.
So given the necessity of buying this quality business during periods of temporary volatility, what is the final provocative thought we leave with the long-term investor?
We've established that the best entry points for a business like Blackstone often happen when the distributable earnings are temporarily depressed, which usually coincides with a period of high regulatory or political noise. So you have to consider whether the ongoing perennial debate over carried interest taxation, which flares up with every budget cycle, is a true material structural threat that will eventually materialize, or if it is merely political theater.
Right.
Often, the best entry points into a fortress business are provided exactly when the political noise about its structure is loudest. The challenge for the thoughtful investor is differentiating genuine regulatory reality
A bill that is actually likely to pass and permanently impair the economics
from the predictable temporary political noise that simply creates an artificially cheap window to acquire an otherwise phenomenal asset. You must become a ruthless assessor of regulatory risk versus temporary political friction.